Bill Miller has been really busy this month. He's released his Q1 2021 market letter to investors, and he's also been interviewed for a Barron's article by William Green, who recently released a book called Richer, Wiser, Happier, which all of you should definitely check out that book. In these pieces, Bill Miller gives his views on the markets, his views on a couple specific companies such as Amazon and GM, and he even touches on Bitcoin. He even talks about how he became a billionaire. And as a value investor, it's probably not how you think. So let's dive into it. William Green gave an excellent introduction to Bill Miller at the beginning of his Barron's article. Bill Miller has had, I'll say, a checkered yet successful history as an investor. He ran the fund for Legg Mason for 15 years and he beat the S&P each one of those years. But he made some misguided and contrarian bets in AIG and Bear Stearns in the 2008 and 2009 financial crisis that ended up having his fund lose about 50% of its value. He went from running $77 billion to $20 billion. But Bill Miller kept at it, and he, needless to say, has made a great comeback. He now runs his own fund, Miller Value Partners, and he's managing a little bit less than $3 billion according to Dataroma. And as a data point, the author offers that Miller Value Trust has returned about 200%, whereas the S&P has only returned about 80%, from the trough of the COVID crisis in March of 2020 till the end of March in 2021. Now that's a little bit about Bill Miller. Let's get into what he was actually discussing in the articles. One of the most astounding parts of this Barron's interview was the revelation that Bill Miller is a huge hodler of Bitcoin. Bill Miller said that he started buying Bitcoin at about $200 to $300 per coin, and that his average cost basis is about $500 per coin. And now Bitcoin is fluctuating somewhere between $50,000 and $60,000 per coin. Now, obviously, those numbers are mind-blowing. I'll let you do the math on those returns. Bill Miller does discuss his rationale for owning Bitcoin. Basically, he says that Bitcoin is a decentralized, permissionless peer-to-peer network of computers that's permanent and unhackable. But it seems like the crux of his argument for owning Bitcoin is that it's actually a scarce resource. Now, there are only going to be 21 million Bitcoin, and about 18.5 million of them have already been mined. The supply of Bitcoin grew 2.5% last year, and it's going to grow another 2% this year. And the question he asks us is the demand for Bitcoin rising at higher than 2%? He also gave this interesting analogy that there are 47 million millionaires in the world, and if each of them wanted to own a Bitcoin, they really couldn't, because there are only ever going to be 21 million Bitcoin in existence. Another factor is that major banks like Morgan Stanley and Goldman Sachs are going to be making Bitcoin available to their clients. So there's going to be institutional adoption of Bitcoin, and also we've seen companies like Tesla, for instance, buy Bitcoin as a replacement for the cash on their balance sheet. He also does mention that Bitcoin seems to be a good alternative to gold, especially for the practical fact that you can't really flee a country with, luggage full of gold, but you can digitally transfer your wealth through Bitcoin and preserve your wealth that way. All in all, he echoes a lot of the Bitcoin proponents like Anthony Pompliano, who say that Bitcoin could someday be worth $10 trillion as a total market cap. Now, I don't know if talking about Bitcoin in terms of market cap versus gold's market cap is the appropriate way to analogize these two assets, but these are some parts of his rationale that he's using to own Bitcoin. And I'm not here to argue the merits of Bill Miller's decision to buy Bitcoin or to argue the rationale behind his decision. I'm not trying to say that it's hindsight bias or anything of that nature, because obviously he's the one sitting there who's made hundreds of millions of dollars likely from his Bitcoin position. So I'm not going to judge him. His investment has paid off. I mean, the point of laying out money now is to make a lot of money in the future, and that's what he's done, and successfully. The Bitcoin investment is the second largest holding in his personal portfolio. Now, the first largest holding is actually Amazon. I did mention earlier in the video that Bill Miller made some pretty big mistakes during the financial crisis in 2008, but one of his greatest, well, I'll call it his greatest investment, was making a huge bet on Amazon at the bottom tick. Miller says that this Amazon bet has grown to 83% of his personal portfolio. Now that's getting to Monish Pabrai levels of concentration. Basically, Bill Miller bought a bunch of call options as Amazon was plummeting in price, and well, we can see today where that company is. So he's obviously had some success with this investment. And he says that the combination of his Amazon investment and his Bitcoin investment have made him comfortably a billionaire. He even says that he owns the most Amazon stock by somebody whose last name isn't Bezos. Despite Amazon being a huge percentage of his portfolio, he says that he's not selling. He thinks in 2 or 3 years, Amazon is going to be a double. In fact, he even says that Amazon isn't expensive, which as a value investor might raise some eyebrows. He says it's trading right in the middle of its historical average based on a few metrics such as price to gross profits and enterprise value to EBITDA. And he says because of the COVID crisis and the digital acceleration of the world in 2020, Amazon's revenues doubled. He also thinks about Amazon in a sum of the parts way. He says that if AWS were its own publicly listed company, that it would be worth probably around $500 billion. And Amazon's market cap right now is about 1.6 trillion. In addition to that, he says that in a few years, AWS alone is probably going to be worth $1 trillion, and then its advertising business might be worth another $500 billion. So basically, we're getting all the retail operations today for free based on those assumptions. And of course, Amazon has a bunch of other bets and irons in the fire that could potentially impact the share price dramatically in the future. He also mentioned Amazon's budding fulfillment business, where they're basically going to build a huge fleet of vans and planes for delivery, and then even sell the excess capacity that they have to other people who need that sort of service. So he says that that business isn't even really priced into the market cap at this point. I'm not an expert on Amazon by any means. Bill Miller very well may be correct. So if he believes that it's going to be a double and he's still holding, then maybe it's worth taking a deep dive into Amazon. I know it's a huge business, but if he sees a pretty safe double, then it's probably worth it. Oh, and one thing to mention, a practical tip for investors, is that he said that if he were buying Amazon for the first time today, he would put 20 to 30% of his net worth into it, which completely astounded me. I mean, if you believe that Amazon, this dominant giant of a company, is safely going to return a double within the next 3 years, then it kind of makes sense if you think about it. I mean, Amazon is super entrenched right now. They're going to continue to grow in both cloud and their retail business. And one thing to note is that just like Facebook, if antitrust laws come and try to break up Amazon, then it's very likely that will benefit a lot of shareholders because, as he mentioned, the individual pieces of Amazon are worth a lot more separate than they currently are being valued as one giant corporation in Amazon. The interview asked him for one stock that he believes is undervalued right now, and Miller actually said GM, or General Motors. It's really refreshing to just get a straight answer about an investment idea from a really prominent investor like Bill Miller. Basically, his investment thesis for GM is that it's slowly becoming an electric vehicle focused company as the combustible engine goes by the wayside, but the valuation has not reflected that idea yet. I haven't done the research on GM, but he says that on a sum of the parts basis, we can see easily at least a 50% or 100% upside for GM. They're sitting at about an 8 times earnings multiple in a market that's about 20 times an earnings multiple on average. And this idea kind of extends to the entire auto industry. Every company is transitioning from gas-powered vehicles to electric vehicles. Now every company is investing in research and development or trying to form partnerships in order to increase their EV footprint. It's actually a bear case for Tesla because as these companies start to pump more and more money into their research, Tesla's product becomes less differentiated. And we begin to see the old traits of the auto industry rearing their ugly head. So as for right now, he thinks GM might be a pretty good investment. All right, let's go over some of the lessons we can take from the Q1 market letter to investors. I'm going to read a couple passages from this because I think they're really impactful and something that we should definitely contemplate as investors. He says, "My concern is not that the market is too expensive or that rising interest rates at the long end, if they continue, will put pressure on valuations or the new supply via SPACs and IPOs will drain demand from the broader market, or that the inflation will prompt the Federal Reserve to tighten sooner than the market anticipates. My concern is that the market goes up far more than even ardent bulls expect, making the vast majority of stocks unattractive, even for those with much longer time horizons than the typical market participant." So it looks like Miller isn't worried that the market's going to crash. I mean, of course, he's obviously calculating that that is a reasonable possibility. However, his bigger concern is that we're going to see a repeat of, say, the tech bubble in '99, where valuations are just going to skyrocket. And that kind of leaves us as investors in the dust. I mean, we're going to be looking for companies that are selling well below their intrinsic valuation, but in an environment that he fears, we are basically not going to be able to find an investment, and therefore it's going to be really hard for us to make appropriate and adequate returns. I appreciate that his natural bent seems to be towards optimism. It reminds me of Monish Pabrai a lot. He also quotes Sir John Templeton saying that bull markets are born in pessimism, grow on skepticism, mature on optimism, and die in euphoria. He believes that most of the market is actually in the optimism phase. However, he does see pockets of euphoria, just like Monish Pabrai, and I'm guessing he's talking about companies like Tesla, for instance. I'll leave links to the Barron's interview and this market letter in the video description below. I would highly encourage you to read both of them in their entirety if you want to learn more about Bill Miller's view on the market. Let me know in the comments below if you read these articles and found any other really interesting insights that I didn't cover in this video. If you liked this video, you may enjoy my video over here where I talk about Monish Pabrai's new investing framework. I really appreciate you sticking all the way to the end. Thank you so much for your time, and thank you for watching, and I will see you next time.